Question 1. Governance review demonstrates that a critical piece of operational equipment has been flagged for a potential safety defect during a routine inspection. While the defect does not pose an immediate catastrophic risk, it significantly increases the likelihood of a minor operational failure that could lead to a temporary shutdown and potential minor injury to an operator. The finance department is strongly advocating for continuing operations to meet quarterly targets, suggesting a review of the defect and a potential repair during the next scheduled maintenance cycle in 3 months. What is the most appropriate course of action? Option A. Immediately cease operations of the affected equipment until the safety defect is fully rectified. Option B. Continue operations but initiate an immediate review of maintenance procedures and schedule a repair within the next 3 months. Option C. Continue normal operations, focusing on meeting financial targets, and address the defect if it leads to a significant incident. Option D. Defer the repair until the next scheduled maintenance cycle, as the defect does not pose an immediate catastrophic risk. The correct answer is A. Immediately cease operations of the affected equipment until the safety defect is fully rectified. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between immediate cost-saving pressures and the long-term implications of compromising on essential safety standards. The decision-maker must balance financial targets with the paramount duty of care to employees and the public, as well as adherence to regulatory requirements. The temptation to cut corners on maintenance, especially when faced with budget constraints, is a common pitfall that requires robust ethical and professional judgment. Correct approach analysis. Prioritizing the immediate cessation of operations until the safety concerns are fully addressed and rectified represents best professional practice. This approach aligns with the fundamental ethical obligation to ensure a safe working environment and to prevent potential harm to individuals and property. From a regulatory perspective, continuing operations with known safety defects would likely violate workplace safety regulations and could lead to severe penalties, including fines, operational shutdowns, and reputational damage. This proactive stance demonstrates a commitment to compliance and a responsible approach to risk management, safeguarding the company's long-term viability and its social license to operate. Incorrect approaches analysis. Opting to proceed with operations while initiating a review of maintenance procedures without immediately halting the unsafe activity constitutes a significant regulatory and ethical failure. This approach prioritizes operational continuity over immediate safety, potentially exposing individuals to harm. It suggests a disregard for established safety protocols and a willingness to accept an unacceptable level of risk. Such a decision could be interpreted as a breach of duty of care and a violation of workplace safety legislation, leading to legal repercussions and severe reputational damage. Choosing to defer the maintenance until the next scheduled service, despite the identified safety issue, is another unacceptable approach. This demonstrates a lack of urgency in addressing critical safety defects and prioritizes convenience or cost over immediate risk mitigation. It directly contravenes the principle of proactive safety management and could result in accidents or incidents, leading to injuries, fatalities, and substantial legal and financial liabilities. This approach also signals a potential systemic issue within the company's safety culture. Ignoring the safety concerns altogether and continuing with normal operations, focusing solely on meeting financial targets, represents the most egregious regulatory and ethical failure. This demonstrates a complete disregard for employee well-being, public safety, and legal obligations. Such an approach is not only professionally irresponsible, but also potentially criminal, exposing the company and its leadership to severe legal penalties, including criminal charges and irreparable damage to its reputation and stakeholder trust. Professional reasoning. Professionals facing such dilemmas should employ a structured decision-making framework. This typically involves 1. Identifying the core issue, recognizing the safety defect and its potential consequences. 2. Gathering information, understanding the nature of the defect, its severity, and the relevant regulations. 3. Identifying stakeholders, considering the impact on employees, customers, the public, and the company. 4. Evaluating options, assessing the risks and benefits of each potential course of action, including the ethical and legal implications. 5. Making a decision, choosing the option that best upholds safety, regulatory compliance, and ethical principles, even if it incurs short-term costs. 6. Implementing and monitoring, taking action and ensuring the issue is resolved and that preventive measures are in place. In this case, the immediate priority must be safety, overriding all other considerations. Question 2. Benchmark analysis indicates that a proposed streamlining of internal reporting procedures could significantly reduce administrative overhead. However, this streamlining may alter the granularity of data captured, potentially impacting the ability to meet certain disclosure requirements under relevant financial regulations. Which of the following approaches best addresses this situation? Option A. Proceed with the streamlining immediately to realize the cost savings, assuming that any minor data discrepancies can be rectified retrospectively if issues arise. Option B. Implement the streamlining and monitor key performance indicators for any immediate negative financial outcomes, addressing any regulatory concerns only if they are explicitly raised by an external party. Option C. Rely on the judgment of the department heads involved in the streamlining to ensure that no critical data is lost without formal documentation or external consultation. Option D. Conduct a thorough impact assessment that quantifies the potential benefits of the streamlining against the risks of non-compliance with disclosure requirements, consulting with legal and compliance teams to ensure adherence to all applicable regulations. The correct answer is D. Conduct a thorough impact assessment that quantifies the potential benefits of the streamlining against the risks of non-compliance with disclosure requirements, consulting with legal and compliance teams to ensure adherence to all applicable regulations. Explanation. This scenario presents a professional challenge because it requires an individual to assess the potential ramifications of a proposed operational change on the company's compliance posture and overall business strategy. The challenge lies in balancing the perceived benefits of the change with its potential risks, particularly in relation to regulatory adherence and market perception. Careful judgment is required to ensure that any decision is not only commercially sound, but also ethically responsible and legally compliant. The correct approach represents best professional practice because it prioritizes a comprehensive and systematic evaluation of the proposed change. This involves understanding the underlying business rationale, identifying all potential impacts across various functional areas, and critically assessing the alignment with existing regulatory frameworks and the company's strategic objectives. By engaging relevant stakeholders and seeking expert advice, this approach ensures that all facets of the impact are considered, leading to a well-informed and defensible decision. This aligns with principles of good corporate governance and risk management, which are implicitly or explicitly mandated by regulatory bodies to ensure the stability and integrity of financial operations. An incorrect approach that focuses solely on immediate cost savings without considering broader implications would be professionally unacceptable. This failure stems from a disregard for potential downstream regulatory breaches, reputational damage, and long-term operational inefficiencies. Such a narrow focus can lead to significant penalties, legal liabilities, and erosion of stakeholder trust, all of which are antithetical to regulatory expectations. Another incorrect approach that relies on anecdotal evidence or the opinions of a few individuals without rigorous analysis is also professionally unsound. This method lacks the objectivity and thoroughness required for sound decision-making. It risks overlooking critical compliance issues or strategic misalignments that could have severe consequences. Regulatory frameworks often demand evidence-based decision-making and due diligence, which this approach fails to provide. The professional decision-making process for similar situations should involve a structured impact assessment framework. This framework should include defining the scope of the assessment, identifying all potential impacts, financial, operational, regulatory, reputational, strategic, gathering relevant data and expert input, evaluating the significance of each impact, developing mitigation strategies for identified risks, and documenting the entire process for audit and review. This systematic approach ensures that decisions are robust, defensible, and aligned with both business objectives and regulatory requirements. Question 3. During the evaluation of a new client's investment portfolio, the client expresses a strong desire to invest in a highly speculative, high-return product that has recently gained significant media attention. The client explicitly states they are aware of the risks but are primarily motivated by the potential for rapid capital appreciation. As a financial advisor, what is the most appropriate course of action? Option A. Immediately invest the client's funds in the requested product, as their stated desire and awareness of risk override the need for further assessment. Option B. Conduct a thorough suitability assessment to determine if the product aligns with the client's overall financial situation, risk tolerance, and investment objectives, and if so, proceed with the recommendation, providing clear disclosures of all risks. Option C. Advise the client that the product is too speculative and refuse to recommend it, suggesting they consider only very conservative investment options. Option D. Invest a small portion of the client's portfolio in the product to satisfy their request, without a full suitability assessment, assuming the risk is manageable. The correct answer is B. Conduct a thorough suitability assessment to determine if the product aligns with the client's overall financial situation, risk tolerance, and investment objectives, and if so, proceed with the recommendation, providing clear disclosures of all risks. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest, particularly when dealing with potentially unsuitable investment products. The advisor must navigate the client's desire for immediate, high returns against the regulatory imperative to ensure suitability and prevent mis-selling. Careful judgment is required to balance client satisfaction with regulatory compliance and ethical obligations. The correct approach represents best professional practice because it prioritizes the client's best interests and adheres strictly to the regulatory framework governing financial advice. This involves conducting a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments. By recommending products that are demonstrably suitable based on this comprehensive assessment, the advisor fulfills their fiduciary duty and complies with regulations designed to protect investors from unsuitable products. This proactive approach mitigates the risk of future client dissatisfaction arising from losses on unsuitable investments and avoids potential regulatory sanctions. An incorrect approach that involves recommending the high-risk, high-return product solely based on the client's stated desire, without a proper suitability assessment, represents a significant regulatory and ethical failure. This would likely breach the duty to act in the client's best interest and could be construed as mis-selling, a serious offense under financial regulations. It prioritizes short-term client appeasement over long-term client welfare and regulatory compliance. Another incorrect approach, such as dismissing the client's request outright without exploring the underlying reasons or offering suitable alternatives, fails to adequately address the client's needs and could damage the client relationship, potentially leading to a complaint or loss of business, and may not fully explore all avenues of suitable investment. The professional decision-making process for similar situations should involve a structured approach. First, actively listen to and understand the client's stated objectives and preferences. Second, conduct a comprehensive fact-find to gather all necessary information regarding their financial circumstances, risk appetite, and investment knowledge. Third, analyze this information to determine the client's true needs and suitability for various investment products. Fourth, present a range of suitable options, clearly explaining the risks and benefits of each and how they align with the client's profile. Finally, document the entire process thoroughly, including the rationale for any recommendations made and the client's decisions. This systematic process ensures that advice is both client-centric and compliant. Question 4. The risk matrix shows a potential conflict of interest where a senior manager has a significant personal investment in a company that is a key supplier to Jardine Cycle and Carriage. This manager is also involved in the procurement decision-making process for this supplier. Which of the following actions best addresses this situation in accordance with robust corporate governance and ethical principles? Option A. The senior manager should continue to participate in procurement decisions, but ensure that all decisions are well documented to demonstrate objectivity. Option B. The senior manager should immediately disclose their personal investment to the compliance department and recuse themselves from any procurement decisions involving the supplier until the conflict is resolved. Option C. The senior manager should discreetly sell their shares in the supplier company without informing anyone to avoid any appearance of impropriety. Option D. The senior manager should inform their direct supervisor verbally about the investment and proceed with their usual decision-making responsibilities. The correct answer is B. The senior manager should immediately disclose their personal investment to the compliance department and recuse themselves from any procurement decisions involving the supplier until the conflict is resolved. Explanation: the risk matrix shows a potential conflict of interest arising from a senior manager's personal investment in a supplier company. This scenario is professionally challenging because it requires balancing business relationships with ethical obligations and regulatory compliance. The senior manager's dual role as an investor and a key decision maker for Jardine Cycle and Carriage creates a situation where personal financial gain could improperly influence procurement decisions, potentially leading to unfair competition, inflated costs, or suboptimal supplier selection. Careful judgment is required to ensure that the company's interests are always prioritized and that all applicable regulations and internal policies are adhered to. The correct approach involves immediate and transparent disclosure of the potential conflict of interest to the appropriate internal authority, such as the compliance department or a designated ethics committee. This aligns with best professional practice as it allows for an objective assessment of the situation and the implementation of appropriate mitigation strategies. Such strategies might include recusal from relevant decision-making processes, divestment of the personal investment, or enhanced oversight of any transactions involving the supplier. This proactive disclosure is ethically sound, demonstrating integrity and a commitment to good corporate governance. It also directly addresses regulatory requirements that mandate the identification and management of conflicts of interest to protect the company and its stakeholders. An incorrect approach would be to ignore the potential conflict, assuming it will not influence decisions or that it is a minor issue. This failure to disclose is a significant ethical lapse and a direct violation of most corporate governance codes and regulatory frameworks designed to prevent conflicts of interest. It undermines trust and can lead to severe reputational damage and financial penalties for the company. Another incorrect approach is to attempt to conceal the investment or downplay its significance. This is dishonest and constitutes a breach of fiduciary duty. It creates a hidden bias that can corrupt decision-making processes, leading to decisions that are not in the best interest of Jardine Cycle and Carriage. Such concealment is a clear regulatory and ethical failure, as it obstructs the company's ability to manage risks effectively and maintain a compliant operating environment. The professional decision-making process for similar situations should involve a clear understanding of the company's code of conduct and relevant regulations concerning conflicts of interest. When a potential conflict is identified, the professional should immediately assess its nature and materiality. The next step is to consult internal policies and seek guidance from the compliance or legal department. Transparency and prompt reporting are paramount. If a conflict exists, the individual must actively participate in developing and adhering to a management plan that neutralizes the conflict and safeguards the company's interests. This process emphasizes proactive risk management and upholds the highest standards of ethical conduct and regulatory compliance. Question 5. Strategic planning requires a financial advisor to adapt to changing market conditions and client sentiment. Following a period of significant market downturn, a client expresses extreme anxiety and demands an immediate shift to a highly speculative, short-term trading strategy to recover losses quickly. The advisor believes this strategy is fundamentally unsuitable given the client's long-term retirement goals and risk tolerance. What is the most appropriate course of action for the advisor? Option A. Advise the client that their emotional reaction is unfounded and that they should stick to the original investment plan without deviation, as market fluctuations are normal. Option B. Immediately implement the client's requested speculative trading strategy to demonstrate responsiveness and attempt to recoup losses, as client satisfaction is paramount. Option C. Engage in a detailed discussion with the client to reevaluate their risk tolerance and financial objectives in light of current market conditions, explaining the potential risks and rewards of various strategies, and proposing a revised plan that balances their concerns with their long-term goals. Option D. Recommend a portfolio of complex, high-yield alternative investments that promise rapid returns, believing this will satisfy the client's desire for quick recovery. Correct answer is C. Engage in a detailed discussion with the client to reevaluate their risk tolerance and financial objectives in light of current market conditions, explaining the potential risks and rewards of various strategies, and proposing a revised plan that balances their concerns with their long-term goals. Explanation. Scenario analysis. This scenario presents a common challenge in financial advisory, where a client's stated investment goals may not align with their risk tolerance or the prevailing market conditions. The professional must navigate the client's emotional responses to market volatility while adhering to regulatory obligations and ethical duties. The challenge lies in balancing client satisfaction with the fiduciary responsibility to provide sound, objective advice that prioritizes the client's long-term financial well-being. Correct approach analysis. The correct approach demonstrates a commitment to the client's best interests and adheres to regulatory principles of suitability and client care. It involves a thorough reassessment of the client's financial situation, risk profile, and objectives in light of current market realities. This approach prioritizes education and open communication, empowering the client to make informed decisions based on realistic expectations. It aligns with the regulatory framework that mandates advisors to understand their clients' circumstances and recommend investments that are suitable, taking into account their knowledge, experience, financial situation, and objectives. This also reflects ethical best practices of transparency and acting with integrity. Incorrect approaches analysis. One incorrect approach involves immediately capitulating to the client's demand for a high-risk, short-term strategy without adequate due diligence. This fails to uphold the advisor's duty of care and suitability, potentially exposing the client to unacceptable risks and violating regulatory requirements that mandate a thorough assessment of risk tolerance and investment objectives. It prioritizes short-term client appeasement over long-term financial security, which is ethically unsound. Another incorrect approach is to dismiss the client's concerns outright and rigidly adhere to the original plan, without considering the impact of market volatility on the client's emotional state and perception of risk. This demonstrates a lack of empathy and professional judgment, potentially damaging the client relationship and failing to adapt advice to evolving circumstances. It neglects the regulatory and ethical imperative to maintain ongoing dialogue and review the suitability of investments. A further incorrect approach might involve recommending overly complex or speculative products to chase returns, without a clear understanding of their suitability for the client's specific situation. This can lead to significant losses and breaches of regulatory obligations related to product knowledge and client suitability. It also raises ethical concerns about potential conflicts of interest if the advisor is incentivized by higher commissions on such products. Professional reasoning. Professionals should adopt a structured decision-making process that begins with active listening and empathy to understand the client's concerns. This should be followed by a comprehensive review of the client's financial situation, risk tolerance, and objectives, considering current market conditions. The professional must then clearly communicate the risks and potential rewards of various strategies, educating the client to make informed decisions. Transparency, objectivity, and a commitment to the client's long-term interest should guide all recommendations. Regular reviews and adjustments to the financial plan are essential to ensure continued suitability. Question 6. Regulatory review indicates that a third-party vendor has requested access to anonymized customer usage data to assist in optimizing the performance of a new fleet management system being implemented by Jardine Cycle and Carriage. While the data is stated to be anonymized, the internal IT department believes this access is crucial for timely system integration and improvement. What is the most appropriate course of action to ensure regulatory compliance and protect customer data? Option A. Grant the third-party vendor access to the anonymized data immediately, as the IT department has deemed it necessary for system optimization, and the data is reportedly anonymized. Option B. Proceed with granting access only after confirming the vendor's adherence to data protection standards through a formal due diligence process, establishing clear contractual terms regarding data usage and security, and obtaining explicit approval from the data protection officer and legal department. Option C. Allow the IT department to provide the vendor with a subset of the data they deem least sensitive, without further external review, to expedite the system integration process. Option D. Inform the third-party vendor that access to any customer data, even anonymized, is strictly prohibited due to potential privacy concerns and the risk of re-identification. The correct answer is A. Grant the third-party vendor access to the anonymized data immediately, as the IT department has deemed it necessary for system optimization, and the data is reportedly anonymized. Explanation. This scenario presents a common challenge in regulatory compliance. balancing the need for efficient business operations with the stringent requirements of data privacy and security. The professional challenge lies in interpreting and applying the Jardine cycle and Carriage's internal policies, which are themselves designed to align with broader regulatory frameworks, to a novel situation involving third-party data access. Careful judgment is required to ensure that any data sharing, even for seemingly beneficial purposes like system improvement, does not inadvertently breach confidentiality or compromise customer information. The correct approach involves a thorough risk assessment and adherence to established data governance protocols. This means verifying the third-party vendor's compliance with data protection laws, ensuring robust contractual agreements are in place that clearly define data usage limitations and security measures, and obtaining necessary internal approvals. This aligns with best professional practice by prioritizing data security and customer trust, which are fundamental to regulatory compliance and the company's reputation. It demonstrates a proactive stance in managing data-related risks, thereby preventing potential breaches and associated penalties. An incorrect approach would be to proceed with data sharing based solely on the perceived benefit of system improvement without due diligence. This could lead to regulatory breaches if the third party mishandles the data, fails to implement adequate security, or uses it beyond the agreed scope. Ethically, it erodes customer trust and could result in significant reputational damage and financial penalties. Another incorrect approach would be to assume that internal IT department approval is sufficient, bypassing the formal data governance and legal review processes. This failure to follow established procedures is a direct violation of internal policy and potentially regulatory requirements, as it bypasses critical checks and balances designed to protect sensitive information. The professional decision-making process for similar situations should involve a structured risk-based approach. First, identify the data involved and its sensitivity. Second, assess the purpose of data access and the potential benefits versus risks. Third, consult relevant internal policies and regulatory guidelines. Fourth, engage with legal and compliance departments to ensure all contractual and regulatory obligations are met. Finally, document the entire process, including risk assessments, approvals, and mitigation strategies, to demonstrate due diligence and accountability. Question 7. Compliance review shows that the client onboarding team is consistently expediting the risk assessment process for new corporate clients, often by reducing the depth of background checks and relying heavily on self-reported information to meet aggressive onboarding targets. Which of the following approaches best addresses this compliance issue while upholding professional standards? Option A. Introduce a simplified, automated risk assessment tool that requires minimal input from the onboarding team, thereby speeding up the process without compromising on basic checks. Option B. Implement a mandatory multi-stage risk assessment protocol for all new corporate clients, requiring sign-off at each stage by a designated compliance officer, and integrate this protocol into the client onboarding system with clear performance metrics that do not solely focus on speed. Option C. Conduct a one-off training session on the importance of risk assessment, but allow the onboarding team to continue their current practices as long as no immediate issues arise. Option D. Advise the onboarding team to continue expediting the process, but to document any deviations from standard procedures, assuming that the volume of business will outweigh potential minor risks. The correct answer is B. Implement a mandatory multi-stage risk assessment protocol for all new corporate clients, requiring sign-off at each stage by a designated compliance officer, and integrate this protocol into the client onboarding system with clear performance metrics that do not solely focus on speed. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires balancing the need for efficient operations with the imperative to maintain robust risk management practices. The pressure to onboard new clients quickly can lead to shortcuts in the risk assessment process, potentially exposing the firm to significant financial, reputational, and regulatory risks. The challenge lies in identifying and mitigating these risks effectively without unduly hindering business growth. Correct approach analysis. The correct approach involves a systematic and documented risk assessment process that is integrated into the client onboarding workflow. This ensures that potential risks are identified, evaluated, and addressed before a client relationship is established. This aligns with the Jardine cycle and Carriage's commitment to responsible business practices and regulatory compliance. A thorough risk assessment, including Know Your Customer (KIC) procedures and anti-money laundering (AML) checks, is fundamental to preventing financial crime and ensuring that the firm does not engage with high-risk individuals or entities. This proactive stance is a cornerstone of sound risk management and ethical conduct. Incorrect approaches analysis. One incorrect approach involves prioritizing speed of onboarding over the thoroughness of the risk assessment. This failure directly contravenes the principles of due diligence and risk mitigation. It creates vulnerabilities that could lead to financial losses, regulatory penalties, and severe reputational damage if the firm is found to be facilitating illicit activities. Ethically, it demonstrates a disregard for the firm's responsibility to prevent financial crime. Another incorrect approach is to rely solely on automated systems without human oversight for risk assessment. While automation can enhance efficiency, it may not capture nuanced risks or complex scenarios that require human judgment and experience. This can lead to missed red flags and an incomplete understanding of a client's risk profile, thereby failing to meet regulatory expectations for comprehensive risk assessment. A third incorrect approach is to conduct risk assessments inconsistently, applying different standards to different clients based on perceived business value. This is discriminatory and creates an uneven playing field, undermining the integrity of the risk management framework. It also opens the firm to accusations of bias and regulatory scrutiny for failing to apply a uniform and objective risk assessment process. Professional reasoning. Professionals should adopt a risk-based approach to client onboarding. This involves establishing clear policies and procedures for risk assessment, ensuring that all relevant information is gathered and analyzed, and that decisions are documented. Regular training and updates on regulatory requirements and emerging risks are crucial. When faced with pressure to expedite processes, professionals must advocate for adherence to established risk management protocols, highlighting the long-term consequences of compromising due diligence. The decision-making process should always prioritize compliance, ethical conduct, and the protection of the firm's reputation and financial stability. Question 8. Governance review demonstrates that a newly identified operational risk stemming from a third-party vendor's data handling practices has the potential for significant reputational damage and regulatory scrutiny. Which of the following is the most appropriate next step in managing this risk? Option A. Conduct a comprehensive risk assessment to understand the nature, likelihood, and impact of the risk, and evaluate existing controls before designing mitigation strategies. Option B. Rely on the vendor's assurances that their data handling practices are compliant and monitor the situation passively. Option C. Immediately terminate the contract with the vendor and seek a new provider to eliminate the risk entirely. Option D. Implement a broad, company-wide policy change to restrict all third-party data sharing, regardless of the specific vendor or risk. The correct answer is C. Immediately terminate the contract with the vendor and seek a new provider to eliminate the risk entirely. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient risk mitigation with the imperative to maintain robust governance and compliance. The challenge lies in identifying the most effective and compliant method to address a newly identified, potentially significant risk within a regulated financial services environment. The chosen approach must not only address the immediate risk, but also align with the overarching principles of sound risk management and regulatory expectations. The correct approach represents best professional practice because it prioritizes a structured, evidence-based, and comprehensive assessment of the identified risk. This involves a thorough understanding of the risk's nature, its potential impact, and the existing controls. By engaging relevant stakeholders and considering both quantitative and qualitative factors, this approach ensures that the subsequent mitigation strategies are proportionate, effective, and aligned with the firm's risk appetite and regulatory obligations. This aligns with the principles of proactive risk management and due diligence expected by regulators. An incorrect approach that focuses solely on immediate, superficial controls without a deeper understanding of the risk's root cause is professionally unacceptable. This failure stems from a lack of due diligence and a potential disregard for the underlying systemic issues. It can lead to ineffective mitigation, wasted resources, and a false sense of security, potentially exposing the firm to continued or even amplified risk. From a regulatory perspective, this demonstrates a failure to implement adequate risk management systems and controls, which can result in supervisory action. Another incorrect approach that relies on anecdotal evidence or the opinions of a single department without broader consultation or objective analysis is also professionally unsound. This approach lacks the rigor required for effective risk assessment and can lead to biased conclusions and inappropriate mitigation strategies. It fails to leverage the collective expertise within the organization and may overlook critical perspectives, thereby increasing the likelihood of regulatory noncompliance and operational failures. Professionals should adopt a systematic decision-making process when faced with risk assessment challenges. This involves 1. Clearly defining the risk and its potential impact. 2. Gathering comprehensive data and evidence. 3. Engaging relevant internal and external stakeholders. 4. Analyzing the risk in the context of the firm's strategy, risk appetite, and regulatory environment. 5. Developing and implementing proportionate mitigation strategies. 6. Continuously monitoring and reviewing the effectiveness of controls. This structured approach ensures that decisions are informed, defensible, and aligned with best practices and regulatory expectations. Question 9. Implementation of a new financial reporting system requires careful consideration of data integrity. Given the tight deadlines for quarterly reports, what approach best ensures the accuracy and reliability of the data processed by the system, while adhering to best practices in data management? Option A. Conduct a comprehensive manual review of all data entries and reports after the system has completed its initial processing. Option B. Integrate automated data validation rules at the point of data entry and during key processing stages to proactively identify and flag discrepancies. Option C. Prioritize the speed of data entry and processing, with a plan to address any identified data errors through a subsequent manual reconciliation process. Option D. Accept all data entries as submitted, assuming that any errors will be minor and can be corrected during the final report generation phase. The correct answer is B. Integrate automated data validation rules at the point of data entry and during key processing stages to proactively identify and flag discrepancies. Explanation: scenario analysis. This scenario presents a professional challenge in balancing the need for efficient data processing with the imperative of maintaining data integrity and adhering to regulatory requirements. The pressure to deliver timely reports, coupled with the potential for human error in manual data entry or validation, creates a complex environment where shortcuts might seem appealing but carry significant risks. The core challenge lies in ensuring that the chosen method for data handling not only meets operational demands, but also upholds the accuracy and reliability expected by stakeholders and mandated by any relevant regulatory framework governing financial data or business operations within Jardine cycle and Carriage operating jurisdiction. Correct approach analysis. The correct approach emphasizes the implementation of robust, automated data validation checks at the point of entry and during processing. This aligns with best practices in data management and is often implicitly or explicitly supported by regulatory guidelines that mandate accurate record-keeping and financial reporting. Automation reduces the likelihood of human error, ensures consistency, and provides an auditable trail. By building validation rules directly into the system, the integrity of the data is maintained proactively, minimizing the need for extensive, error-prone manual reconciliation later. This approach fosters trust in the data and the reports generated from it, which is crucial for informed decision-making and compliance. Incorrect approaches analysis. Relying solely on manual review of data after it has been entered and processed represents a significant regulatory and ethical failure. Manual reviews are prone to oversight, fatigue, and subjective interpretation, increasing the risk of undetected errors that could lead to inaccurate financial reporting or operational misjudgments. This approach fails to meet the standard of due diligence expected in data management. Accepting data entries without any form of automated validation, even if followed by a manual review, is also problematic. It bypasses a critical layer of data quality control. This can lead to the propagation of errors throughout the system, making subsequent correction more difficult and costly. It demonstrates a lack of proactive risk management regarding data integrity. Implementing a system that prioritizes speed over accuracy, even with the intention of correcting errors later, is fundamentally flawed. Regulatory frameworks typically require accurate data from the outset. The assumption that errors can be easily fixed later is often unrealistic and can lead to a cascade of issues, including misstated financial positions and potential breaches of reporting obligations. This approach prioritizes expediency over compliance and accuracy. Professional reasoning. Professionals should adopt a proactive, risk-based approach to data management. This involves understanding the potential impact of data inaccuracies on business operations, financial reporting, and regulatory compliance. The decision-making process should prioritize the implementation of controls that prevent errors from occurring or detect them as early as possible. This includes leveraging technology for automation and validation, establishing clear data governance policies, and ensuring continuous training for personnel involved in data handling. When faced with competing demands of speed and accuracy, the professional's judgment must be guided by the principle of maintaining data integrity as a non-negotiable foundation for all subsequent activities. Question 10. The audit findings indicate that the recent acquisition of a significant fleet of new vehicles involved several deviations from the established internal procurement policy, including expedited vendor selection and a lack of comprehensive due diligence on the chosen supplier's track record. Which of the following approaches best addresses these findings to ensure future compliance and mitigate risks? Option A. Conduct a comprehensive review of the procurement policy, verify the vendor selection criteria used against policy requirements, and assess the approval workflow for any procedural shortcuts taken. Option B. Immediately implement a new, more stringent procurement policy without first analyzing the specific reasons for the deviations in the current process. Option C. Rely on the assurances of the procurement department that the chosen vendor is reputable and that the expedited process was necessary due to market pressures. Option D. Focus on renegotiating the terms of the current vehicle acquisition to secure better pricing, assuming the operational need for the vehicles outweighs the procedural deviations. The correct answer is A. Conduct a comprehensive review of the procurement policy, verify the vendor selection criteria used against policy requirements, and assess the approval workflow for any procedural shortcuts taken. Explanation. The audit findings indicate a potential breakdown in the internal controls surrounding the procurement process for new vehicle fleets. This scenario is professionally challenging because it requires a nuanced understanding of how to balance operational efficiency with robust compliance and risk management. The pressure to acquire vehicles quickly to meet market demand might tempt management to overlook procedural steps, creating a fertile ground for errors, fraud, or non-compliance with internal policies and potentially external regulations governing fair procurement practices. The correct approach, which involves a thorough review of the procurement policy, verification of vendor selection criteria, and an assessment of the approval workflow, represents best professional practice. This aligns with the principles of good corporate governance and the Jardine cycle and Carriage's commitment to ethical business conduct. By systematically examining each stage of the procurement process, the company can identify weaknesses, ensure adherence to established policies, and mitigate risks of financial impropriety or reputational damage. This proactive stance is crucial for maintaining stakeholder trust and operational integrity. An incorrect approach that bypasses a detailed review of the procurement policy and vendor selection criteria would be professionally unacceptable. This failure to scrutinize the foundational elements of the procurement process could lead to the perpetuation of flawed practices, potentially resulting in the selection of vendors based on criteria other than merit, cost-effectiveness, or compliance. Such an oversight could also violate principles of fairness and transparency, potentially exposing the company to legal challenges or regulatory scrutiny if procurement practices are found to be discriminatory or non-compliant with any applicable industry standards or company codes of conduct. Another incorrect approach, focusing solely on the financial implications without investigating the procedural integrity of the procurement, would also be professionally deficient. While financial oversight is critical, it does not address the root causes of potential control weaknesses. Ignoring the process itself means that even if current transactions appear financially sound, the underlying system remains vulnerable to future manipulation or error. This reactive, rather than proactive, approach fails to build a sustainable control environment. Finally, an approach that relies solely on anecdotal evidence or the assurances of the procurement team without independent verification would be a significant professional failing. This demonstrates a lack of due diligence and an over-reliance on potentially biased information. Best professional practice demands objective evidence and rigorous verification to ensure that internal controls are effective and that business operations are conducted ethically and in compliance with all relevant guidelines. The professional decision-making process for similar situations should involve a structured approach. First, understanding the scope and nature of the audit findings. Second, identifying the relevant internal policies and external regulations. Third, systematically evaluating the process against these benchmarks. Fourth, gathering objective evidence to support or refute the findings. And fifth, recommending and implementing corrective actions that address the root causes of the identified issues, ensuring long-term control effectiveness and ethical conduct. Question 11. Risk assessment procedures indicate that the upcoming migration to a new client relationship management (CRM) system for Jardine cycle and carriage operations presents potential challenges in ensuring the integrity and confidentiality of sensitive client data during the transition. Given the critical nature of client information and the company's commitment to regulatory compliance, which of the following implementation strategies would best mitigate these risks? Option A. Conduct a comprehensive data cleansing and validation exercise on the existing data before migration, followed by a phased rollout of the new CRM system with rigorous testing and verification at each stage of data transfer and system integration. Option B. Prioritize the speed of the migration to minimize disruption, transferring data directly from the old system to the new one with minimal pre-migration checks, and addressing any data discrepancies or security concerns post-implementation. Option C. Proceed with a big bang migration of all client data, the new CRM system over a single weekend, relying on the vendor's standard migration tools and assuming minimal data loss or corruption. Option D. Implement the new CRM system with a focus on core functionalities first, migrating only essential client contact details, and deferring the transfer of more sensitive financial or personal data until a later, unspecified phase. The correct answer is A. Conduct a comprehensive data cleansing and validation exercise on the existing data before migration, followed by a phased rollout of the new CRM system, with rigorous testing and verification at each stage of data transfer and system integration. Explanation. This scenario presents a professional challenge due to the inherent conflict between maintaining operational efficiency and adhering to stringent regulatory requirements for data handling and client confidentiality. The need to implement a new system while ensuring all data migration is compliant with Jardine cycle and Carriage's internal policies and any applicable external regulations. Assuming a Singaporean context for Jardine cycle and Carriage, this would involve PDPA considerations, requires a delicate balance. The pressure to deliver a new system quickly can tempt shortcuts, but the potential for data breaches or non-compliance carries significant reputational and legal risks. The correct approach represents best professional practice because it prioritizes a phased implementation with robust testing and validation at each stage. This methodical process ensures that data integrity is maintained throughout the migration and that the new system's controls are effective in protecting sensitive information. It aligns with the principle of privacy by design and demonstrates a commitment to regulatory compliance and client trust, which are paramount in the financial services sector. This approach minimizes the risk of unforeseen issues and allows for timely remediation if problems arise, thereby safeguarding the company and its clients. An incorrect approach that involves a big bang migration without adequate pre-migration data cleansing and post-migration validation would be professionally unacceptable. This would likely lead to data corruption, potential breaches of client confidentiality, and non-compliance with data protection regulations such as the Personal Data Protection Act, PDPA, in Singapore. Such an approach disregards the fundamental need for data accuracy and security, exposing the organization to significant legal penalties and reputational damage. Another incorrect approach, which is to proceed with the migration based solely on the vendor's assurances without independent verification, fails to exercise due diligence. This abdicates responsibility for ensuring compliance and data security, relying on a third party whose primary interest may be sales rather than the client's specific regulatory environment. This oversight could result in the implementation of a system that, while functional, does not meet the stringent data handling and privacy standards required by Jardine Cycle and Carriage and its regulators. The professional decision-making process for similar situations should involve a thorough risk assessment that identifies potential data security and compliance vulnerabilities. This should be followed by the development of a detailed implementation plan that includes clear milestones for testing, validation, and regulatory review. Stakeholder engagement, including IT, legal, compliance, and business units, is crucial to ensure all perspectives and requirements are considered. A contingency plan should also be in place to address any unexpected issues that may arise during the implementation. Question 12. The performance metrics show a significant increase in customer onboarding time following the introduction of new Know Your Customer (KYC) procedures mandated by the Customer Due Diligence Enhancement Act. While the intention was to strengthen compliance, the current process is proving inefficient and is impacting customer satisfaction. What is the most appropriate strategic approach to address this implementation challenge? Option A. Implement a company-wide, rapid overhaul of the onboarding system to accommodate all perceived changes from the Customer Due Diligence Enhancement Act without extensive prior testing. Option B. Immediately revert to the previous KYC procedures to restore onboarding efficiency and address the Customer Due Diligence Enhancement Act requirements at a later, less critical time. Option C. Initiate a comprehensive review of the new KYC procedures, conduct a gap analysis against the Customer Due Diligence Enhancement Act, and implement a phased rollout of revised processes, starting with a pilot program, to ensure effectiveness and minimize disruption. Option D. Delegate the entire responsibility for resolving the onboarding delays to the IT department, assuming they can independently rectify the system issues related to the new KYC procedures. Correct answer is C. Initiate a comprehensive review of the new KYC procedures, conduct a gap analysis against the Customer Due Diligence Enhancement Act, and implement a phased rollout of revised processes, starting with a pilot program, to ensure effectiveness and minimize disruption. Explanation. Scenario analysis. This scenario presents a common implementation challenge where a new regulatory requirement, the Customer Due Diligence Enhancement Act, necessitates significant changes to existing operational processes. The challenge lies in balancing the urgency of compliance with the practicalities of system integration and staff training, all while minimizing disruption to daily business operations. The potential for misinterpretation of the Act's provisions and the risk of inadequate implementation pose significant compliance and reputational risks. Correct approach analysis. The correct approach involves a phased implementation strategy, starting with a thorough review of the Customer Due Diligence Enhancement Act to identify all specific requirements. This is followed by a detailed gap analysis against current processes and systems. Subsequently, a pilot program with a subset of customers or branches allows for testing and refinement of the new procedures before a full rollout. This methodical approach ensures that the implementation is robust, compliant with the Act, and minimizes operational disruption. It aligns with best practices for regulatory compliance, emphasizing a proactive and risk-based methodology. The regulatory framework for financial institutions, as exemplified by the principles underpinning the Jardine Cycle and Carriage hiring assessment test, mandates a diligent and systematic approach to compliance to protect both the institution and its customers. Incorrect approaches analysis. One incorrect approach involves immediate, company-wide implementation of all perceived changes without adequate planning or testing. This risks significant operational disruption, potential data errors, and non-compliance if initial interpretations of the Act are flawed. It fails to adhere to the principle of proportionality and risk management inherent in regulatory compliance frameworks, potentially leading to breaches of the Customer Due Diligence Enhancement Act. Another incorrect approach is to delay implementation until the last possible moment, relying on ad hoc solutions as issues arise. This is a reactive strategy that significantly increases the risk of non-compliance and potential penalties. It demonstrates a lack of foresight and commitment to regulatory obligations, which is a direct contravention of the proactive compliance expected under the Act and general good governance principles. A third incorrect approach is to implement changes based solely on the interpretation of a single department without cross-functional consultation. This can lead to incomplete or conflicting procedures, overlooking critical aspects of the Customer Due Diligence Enhancement Act that impact other business areas. It violates the principle of integrated compliance and can result in systemic weaknesses that expose the company to regulatory scrutiny. Professional reasoning. Professionals facing such implementation challenges should adopt a structured, risk-based approach. This involves 1. Understanding the regulatory requirement thoroughly. 2. Assessing the impact on current operations and systems. 3. Developing a detailed implementation plan with clear timelines and responsibilities. 4. Incorporating testing and feedback mechanisms. 5. Ensuring adequate training for all affected staff. 6. Establishing ongoing monitoring and review processes to ensure sustained compliance. This systematic process mitigates risks, ensures effective implementation, and upholds professional and regulatory standards. Question 13. Investigation of a new corporate client's beneficial ownership structure reveals a complex web of offshore entities. The sales team is eager to close the deal, citing significant revenue potential and the client's apparent legitimacy. They propose proceeding with onboarding while completing the detailed beneficial ownership verification post-onboarding, suggesting that the client's reputation and initial documentation appear satisfactory. What is the most appropriate course of action for the compliance officer? Option A. Accept the client's assurances regarding their beneficial ownership and proceed with onboarding, deferring the in-depth verification to a later, less critical period. Option B. Onboard the client immediately to secure the revenue, and then initiate the verification process, prioritizing it based on available resources and other ongoing compliance tasks. Option C. Proceed with onboarding the client based on the sales team's assessment of legitimacy and the client's apparent reputation, with a commitment to complete the detailed verification within a specified short time frame. Option D. Insist on completing the full verification of the beneficial ownership structure, including tracing through all offshore entities, before onboarding the client, regardless of the sales team's urgency. The correct answer is D. Insist on completing the full verification of the beneficial ownership structure, including tracing through all offshore entities, before onboarding the client, regardless of the sales team's urgency. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the need to quickly onboard a new client to meet business targets and the regulatory obligation to conduct thorough know-your-customer kick procedures. The pressure to meet targets can lead to a temptation to cut corners, which directly contravenes anti-money laundering (AML) and customer due diligence (CDD) requirements. The complexity arises from balancing commercial imperatives with legal and ethical responsibilities, requiring careful judgment to avoid regulatory breaches and reputational damage. Correct approach analysis. The correct approach involves prioritizing the completion of all mandatory KYC checks, including verifying the client's identity, understanding the nature of their business, and assessing any potential risks before onboarding. This aligns with the principles of robust AML and CDD frameworks, which are fundamental to preventing financial crime. Adhering to these procedures demonstrates a commitment to regulatory compliance, protects the firm from financial penalties and reputational harm, and upholds ethical standards by ensuring the firm does not facilitate illicit activities. This proactive stance is a cornerstone of responsible financial services. Incorrect approaches analysis. Proceeding with onboarding without completing all KYC checks, despite knowing they are incomplete, constitutes a direct breach of regulatory requirements. This failure to perform adequate CDD is a serious regulatory and ethical lapse, exposing the firm to significant fines, sanctions, and reputational damage. It also increases the risk of the firm being used for money laundering or terrorist financing. Accepting a client's assurances without independent verification of their identity or business activities is another critical failure. Regulatory frameworks mandate that firms conduct their own due diligence and cannot rely solely on client self-declarations, especially when red flags or high-risk indicators are present. This approach bypasses essential risk assessment and control mechanisms. Delaying KYC checks until after onboarding, with the intention of completing them later, is also unacceptable. The regulatory requirement is to perform these checks before establishing a business relationship. Post-onboarding checks, while better than none, do not fulfill the initial due diligence obligations and still leave the firm exposed during the period the client is active without proper vetting. Professional reasoning. Professionals should adopt a risk-based approach to client onboarding. This involves understanding the firm's regulatory obligations, identifying potential risks associated with different client types and activities, and implementing proportionate controls. When faced with pressure to expedite onboarding, professionals must clearly articulate the regulatory requirements and the potential consequences of noncompliance to stakeholders. Escalating concerns to senior management or compliance departments is crucial if commercial pressures threaten to override regulatory mandates. The decision-making process should always prioritize compliance and ethical conduct, recognizing that short-term gains achieved through regulatory shortcuts lead to long-term detrimental outcomes. Question 14. The audit findings indicate that a senior manager has consistently approved purchase orders for a key supplier, and subsequent investigation reveals that this supplier is substantially owned by the manager's sibling. The manager has not disclosed this relationship to their superiors or the compliance department. Which of the following actions best addresses this situation in accordance with ethical business practices and internal company policies? Option A. The manager should delegate the approval process for this supplier to a trusted subordinate without informing them of the relationship. Option B. The manager should dismiss the audit findings as a minor oversight and continue business as usual, as long as the supplier offers competitive pricing. Option C. The manager should immediately disclose the relationship to the compliance department and recuse themselves from all future decisions involving this supplier, while the compliance department reviews past transactions for any impropriety. Option D. The manager should continue approving purchase orders, but ensure that all decisions are thoroughly documented to demonstrate objective reasoning. The correct answer is C. The manager should immediately disclose the relationship to the compliance department and recuse themselves from all future decisions involving this supplier, while the compliance department reviews past transactions for any impropriety. Explanation. The audit findings indicate a potential conflict of interest arising from a senior manager's involvement in approving supplier contracts where their close relative holds a significant stake. This scenario is professionally challenging because it requires balancing business efficiency with ethical conduct and regulatory compliance. The core tension lies in ensuring that decisions are made impartially, free from undue personal influence, and in the best interest of Jardine Cycle and Carriage. The correct approach involves immediate disclosure of the potential conflict of interest to the appropriate compliance or legal department, followed by recusal from any decision-making processes related to the identified supplier. This aligns with the principles of good corporate governance and ethical conduct expected under relevant employment policies and potentially broader corporate law frameworks that mandate transparency and the avoidance of conflicts of interest. By disclosing and recusing, the manager upholds their fiduciary duty to the company, ensures fair procurement processes, and prevents any perception of impropriety, thereby safeguarding the company's reputation and financial integrity. This proactive step is crucial for maintaining trust and adhering to internal controls designed to prevent fraud and corruption. An incorrect approach would be to proceed with contract approval without disclosure, rationalizing that the relative stake is minor or that the decision is based purely on merit. This fails to acknowledge the inherent risk of bias and violates the principle of transparency. It could lead to regulatory breaches if such conflicts are explicitly prohibited by company policy or employment law, and it erodes ethical standards by creating an environment where personal gain can influence business decisions. Another incorrect approach would be to delegate the decision to a subordinate without disclosing the conflict. While this might seem like a way to avoid direct involvement, it does not resolve the underlying conflict. The manager still benefits indirectly from a decision they influenced, and the subordinate may be placed in an ethically compromised position, potentially unaware of the full implications. This circumvents the spirit of conflict of interest policies and can still lead to reputational damage if discovered. A further incorrect approach would be to ignore the audit findings and continue the practice, assuming no harm has been done. This demonstrates a willful disregard for internal controls and ethical obligations. It exposes the company to significant legal and financial risks, including potential penalties, contract invalidation, and severe reputational damage. It also signals a lack of commitment to ethical leadership and compliance. A professional decision-making process in such situations should involve a clear understanding of the company's code of conduct and conflict of interest policies. When a potential conflict arises, the professional must first identify it, then assess its materiality and impact. the immediate next step should be to seek guidance from the designated compliance officer or legal counsel. Transparency and adherence to established procedures are paramount. This structured approach ensures that decisions are not only legally compliant, but also ethically sound, fostering a culture of integrity within the organization. Question 15. When evaluating potential process optimizations within the hiring department to improve turnaround times, which of the following approaches best balances efficiency gains with adherence to regulatory and ethical standards? Option A. Prioritizing the adoption of new, unproven automated screening software that promises significant time savings, without a thorough review of its data handling capabilities or potential biases. Option B. Implementing a streamlined application review process that reduces the number of mandatory screening steps based on initial feedback from a few hiring managers. Option C. Conducting a comprehensive analysis of the entire hiring workflow, involving input from HR, legal, and operational teams, to identify bottlenecks and propose data-driven improvements that are then rigorously tested for compliance and effectiveness. Option D. Focusing solely on reducing the budget allocated to candidate background checks to accelerate the final hiring decision. Correct answer is B. Implementing a streamlined application review process that reduces the number of mandatory screening steps based on initial feedback from a few hiring managers. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for efficiency with the long-term implications of process changes on compliance and operational integrity. The Jardine cycle and Carriage hiring assessment test, in its focus on process optimization, implicitly requires adherence to established regulatory frameworks and ethical guidelines governing hiring and operational processes. Careful judgment is needed to ensure that optimization efforts do not inadvertently lead to breaches of these standards. The correct approach represents best professional practice because it prioritizes a thorough, data-driven review that considers all stakeholders and potential impacts, including regulatory compliance and ethical considerations. This aligns with the principles of responsible business operations, which are often underpinned by specific regulations and industry best practices that Jardine cycle and Carriage would be expected to follow. By involving relevant departments and seeking expert input, the process ensures that any proposed optimizations are not only efficient, but also legally sound and ethically defensible. This proactive approach mitigates risks and fosters a culture of continuous improvement that respects established governance. An incorrect approach that focuses solely on cost reduction without considering the impact on compliance procedures would be professionally unacceptable. This could lead to the circumvention of necessary checks and balances, potentially violating data privacy regulations, e.g., if candidate information is mishandled, or employment law, e.g., if hiring criteria are inadvertently biased due to a rushed process. Another incorrect approach that involves implementing changes without proper testing or validation risks introducing new inefficiencies or errors, undermining the very goal of optimization, and potentially leading to operational disruptions that could have financial and reputational consequences. Furthermore, bypassing established approval workflows or ignoring feedback from operational teams demonstrates a disregard for internal controls and collaborative best practices, which are crucial for maintaining a well-functioning and compliant organization. Professionals should employ a decision-making framework that begins with clearly defining the objectives of process optimization. This should be followed by a comprehensive assessment of the current process, identifying bottlenecks and areas for improvement. Crucially, this assessment must include an evaluation of the regulatory and ethical implications of any proposed changes. Solutions should then be developed collaboratively, involving all affected parties and subject matter experts. Pilot testing and thorough validation are essential before full implementation. Finally, ongoing monitoring and evaluation are necessary to ensure that the optimized process remains effective, compliant, and aligned with organizational goals. Question 16. System analysis indicates that a new, more efficient workflow for loan application processing has been developed. This workflow promises to reduce processing times by 20% and associated operational costs by 15%. However, initial internal reviews suggest that the new workflow might slightly alter the sequence of data verification steps, potentially impacting the granularity of audit trails required by local financial regulations. Additionally, There are concerns that the streamlined customer interaction points might reduce opportunities for proactive customer support during the application phase. Considering these potential impacts, what is the most prudent approach to implementing this optimized workflow? Option A. Conduct a pilot program of the new workflow in a select group of branches, closely monitoring audit trail generation and customer feedback. Based on the pilot results, refine the workflow before a full-scale rollout. Option B. Focus on the efficiency gains and implement the new workflow, while simultaneously launching a separate initiative to enhance customer support channels to compensate for the reduced interaction during the application process, without re-evaluating the workflow itself. Option C. Prioritize the cost and time savings by implementing the new workflow universally, and instruct the compliance department to retroactively adjust audit trail documentation procedures to meet regulatory requirements. Option D. Implement the new workflow across all branches immediately to realize the projected cost and time savings, and address any compliance or customer service issues that arise reactively. Correct answer is D. Implement the new workflow across all branches immediately to realize the projected cost and time savings, and address any compliance or customer service issues that arise reactively. Explanation. Scenario analysis. The scenario presents a common challenge in process optimization, balancing efficiency gains with potential impacts on compliance and customer service. Jardine cycle and Carriage, operating within a regulated environment, must ensure that any process improvements do not inadvertently create risks of non-compliance with local regulations or negatively affect customer experience, which could lead to reputational damage and potential regulatory scrutiny. The challenge lies in identifying the optimal path that maximizes efficiency without compromising these critical areas. Correct approach analysis. The correct approach involves a phased implementation with robust monitoring and feedback loops. This aligns with best professional practice by prioritizing a controlled rollout. Specifically, it demonstrates adherence to regulatory principles of risk management and due diligence. By piloting the optimized process in a limited scope, the company can identify and rectify any unforeseen compliance gaps or service disruptions before a full-scale deployment. This proactive approach minimizes the potential for widespread regulatory breaches or customer dissatisfaction, which are key concerns for any financial services entity. The emphasis on collecting feedback from both internal stakeholders, e.g., compliance officers, operations staff, and external stakeholders, e.g., customers, ensures that the optimization is not only technically sound, but also practically effective and compliant. This iterative refinement process is a cornerstone of responsible process management in regulated industries. Incorrect approach is analysis. Implementing the optimized process across all operations immediately without prior testing or validation represents a significant regulatory and ethical failure. This approach disregards the principle of risk assessment, potentially exposing the company to widespread non-compliance with local financial regulations. If the optimization inadvertently alters data handling, reporting, or customer interaction protocols in a way that contravenes established rules, the consequences could be severe, including fines, sanctions, and reputational damage. Focusing solely on cost reduction without considering the impact on customer service or regulatory adherence is another flawed approach. While efficiency is a goal, it cannot come at the expense of customer trust or legal obligations. A process that is cheaper but leads to increased customer complaints, delays in service delivery, or breaches of data privacy regulations is ultimately detrimental to the business and violates ethical obligations to customers and regulatory bodies. Ignoring feedback from operational staff and compliance teams during the optimization phase is also a critical failure. These individuals possess invaluable on-the-ground knowledge of existing processes and potential pitfalls. Disregarding their input suggests a lack of due diligence and a failure to engage with key stakeholders, increasing the likelihood of overlooking compliance issues or operational inefficiencies that could arise from the changes. This can lead to a process that is theoretically optimized but practically unworkable or non-compliant. Professional reasoning. Professionals in regulated environments must adopt a risk-based and stakeholder-centric approach to process optimization. The decision-making process should involve 1. Comprehensive assessment of potential impacts. Before any changes, thoroughly evaluate how the optimization might affect regulatory compliance, customer experience, data security, and operational integrity. 2. Stakeholder engagement. Involve relevant departments, compliance, legal, operations, customer service, and potentially external experts early and continuously in the process. 3. Phased implementation and testing. Pilot new processes in controlled environments to identify and mitigate risks before full rollout. 4. Robust monitoring and feedback mechanisms. Establish clear metrics to track performance, compliance, and customer satisfaction post-implementation, and create channels for ongoing feedback. 5. Iterative refinement. Be prepared to adjust and refine the optimized process based on monitoring data and feedback to ensure sustained effectiveness and compliance. Question 17. The risk matrix shows a moderate likelihood of a critical process failure impacting customer service delivery due to an outdated manual data entry system. Considering the need for continuous improvement and risk mitigation, which of the following approaches to process optimization is most professionally sound? Option A. Address the immediate symptoms of process failure by implementing temporary workarounds and additional manual checks, deferring any significant system changes until a later, less critical period. Option B. Conduct a superficial review of the manual system, making minor adjustments to existing procedures without a deep dive into root causes, and then proceed with a broad, unpiloted implementation of these minor changes. Option C. Immediately replace the manual data entry system with a new, complex software solution, assuming it will inherently resolve all identified issues without extensive user training or process reengineering. Option D. Implement a phased approach to process optimization, starting with a detailed analysis of the current manual system, identifying key bottlenecks and failure points, developing targeted improvements, and piloting these changes with a small user group before a full rollout. The correct answer is D. Implement a phased approach to process optimization, starting with a detailed analysis of the current manual system, identifying key bottlenecks and failure points, developing targeted improvements, and piloting these changes with a small user group before a full rollout. Explanation. The risk matrix shows a moderate likelihood of a critical process failure impacting customer service delivery due to an outdated manual data entry system. This scenario is professionally challenging because it requires balancing immediate operational needs with long-term strategic improvements, while also considering resource constraints and potential disruption. The urgency of customer service delivery conflicts with the time and investment needed for a comprehensive process optimization. Careful judgment is required to select an approach that mitigates risk effectively without causing undue harm to current operations or customer satisfaction. The correct approach represents best professional practice because it prioritizes a structured, data-driven methodology for process optimization. This involves a thorough analysis of the current state, identification of root causes of inefficiency and risk, and the development of targeted solutions. By engaging stakeholders and piloting changes, it ensures that the optimization is practical, sustainable, and aligned with business objectives. This aligns with ethical obligations to maintain operational integrity and customer trust, and regulatory expectations for robust risk management and efficient business practices. An incorrect approach that focuses solely on immediate, superficial fixes without understanding the underlying systemic issues is professionally unacceptable. This could lead to recurring problems and a false sense of security, failing to address the root cause of the risk identified in the matrix. Such an approach neglects the professional duty to implement lasting solutions and may violate implicit or explicit regulatory requirements for effective operational management. Another incorrect approach that involves a complete overhaul without proper planning or stakeholder buy-in is also professionally unacceptable. This can lead to significant disruption, increased costs, and potential failure to achieve the desired outcomes. It demonstrates a lack of due diligence and a disregard for the impact on employees and customers, potentially leading to breaches of service-level agreements or other operational standards. A professional decision-making process for similar situations should involve 1. Understanding the full scope of the risk and its potential impact. 2. Evaluating various optimization strategies based on their feasibility, cost-effectiveness, and potential for disruption. 3. Consulting with relevant stakeholders to gather insights and ensure buy-in. 4. Prioritizing solutions that offer the greatest risk reduction and operational improvement with acceptable levels of disruption. 5. implementing changes in a phased and controlled manner with continuous monitoring and evaluation. Question 18. The efficiency study reveals that a newly implemented operational process has significantly reduced processing times, directly leading to cost saving that benefit a specific department where a key stakeholder holds a senior evaluation role. This stakeholder is responsible for assessing the overall success and future of this new process. What is the most appropriate course of action for this stakeholder? Option A. Focus solely on the technical aspects of the process's efficiency, disregarding the financial implications that create the conflict of interest. Option B. Continue to participate fully in the evaluation, assuming their professional judgment is objective and unaffected by the departmental cost savings. Option C. Privately communicate their concerns about potential biases to a trusted colleague, hoping they will address the issue without formal disclosure. Option D. Disclose the personal benefit derived from the process's success and recuse themselves from any evaluation decisions that directly impact the financial outcomes for their department related to this process. The correct answer is D. Disclose the personal benefit derived from the process's success and recuse themselves from any evaluation decisions that directly impact the financial outcomes for their department related to this process. Explanation. Scenario analysis. This scenario presents a professional challenge where a newly implemented operational process, intended to improve efficiency, has inadvertently created a conflict of interest for a key stakeholder. The challenge lies in balancing the pursuit of operational improvements with the ethical and regulatory obligations to ensure fair dealing and prevent undue advantage. The stakeholder's dual role as both a beneficiary of the new process and a decision-maker regarding its ongoing evaluation requires careful navigation to avoid perceptions or actual instances of bias. Judgment is required to identify and mitigate potential conflicts without undermining the integrity of the efficiency study or the stakeholder's professional responsibilities. Correct approach analysis. The correct approach involves proactively identifying the conflict of interest and implementing robust mitigation strategies. This aligns with the Jardine cycle and Carriage's commitment to ethical conduct and regulatory compliance, which likely includes guidelines on managing conflicts of interest. Best professional practice dictates transparency and accountability. By disclosing the conflict and recusing themselves from decisions directly impacting their personal benefit from the process, the stakeholder upholds their fiduciary duty and maintains the credibility of the efficiency study. This approach ensures that decisions are made objectively, free from personal bias, and in the best interest of the company, thereby adhering to principles of good corporate governance and potentially specific internal policies or industry best practices that Jardine Cycle and Carriage would expect its employees to follow. Incorrect approaches analysis. Continuing to participate in the evaluation without disclosure or mitigation is a significant regulatory and ethical failure. It breaches the principle of acting in the best interest of the company and creates an environment ripe for biased decision-making. This could violate internal codes of conduct and potentially broader regulatory expectations regarding fair business practices. Ignoring the conflict and proceeding as if it does not exist is also a failure. It demonstrates a lack of professional integrity and an unwillingness to address potential impropriety. This passive approach can lead to the erosion of trust among colleagues and stakeholders and could have legal or reputational repercussions if the conflict leads to detrimental decisions for the company. Attempting to subtly influence the evaluation to favor the outcome that benefits them, even without explicit disclosure, is a form of misconduct. This is a direct violation of ethical principles and could be construed as fraudulent or deceptive behavior, leading to severe disciplinary action and potential legal consequences. Professional reasoning. Professionals in such situations should first recognize that any potential conflict of interest, perceived or actual, must be addressed. The decision-making process should involve 1. Identification. Clearly identify the nature of the conflict. 2. Disclosure. Transparently communicate the conflict to relevant parties, e.g., supervisor, compliance department. 3. Mitigation. Propose and implement appropriate measures to manage the conflict, such as recusal from specific decisions or seeking independent review. 4. Documentation. Record the conflict and the mitigation steps taken. This systematic approach ensures that ethical standards are upheld and regulatory obligations are met, safeguarding both the individual's professional standing and the company's reputation. Question 19. Strategic planning requires a thorough assessment of a subsidiary's financial health and market position. Jardine Cycle and Carriage is considering a significant investment in a new technology for one of its automotive dealerships in a developing market. This investment is projected to incur substantial upfront costs and may not yield significant returns for at least 3 to 5 years, but it is expected to position the dealership as a market leader in the long term. The parent company is currently experiencing some short-term cash flow pressures. Which of the following approaches best balances the subsidiary's long-term strategic needs with the parent company's immediate financial considerations and stakeholder interests? Option A. Postpone the investment indefinitely until the parent company's cash flow situation improves significantly, prioritizing immediate cost-saving measures within the subsidiary to bolster its short-term financial performance. Option B. Conduct a comprehensive feasibility study that includes detailed market analysis, competitor benchmarking, and robust financial projections for the next 10 years, factoring in both the upfront investment costs and the anticipated long-term revenue growth and market share gains, while also exploring potential financing options that minimize immediate impact on the parent company's cash flow. Option C. Proceed with the investment immediately, assuming the long-term benefits will outweigh any short-term financial strain, without a detailed analysis of the subsidiary's specific market dynamics or the parent company's true capacity to absorb the initial costs. Option D. Focus solely on the parent company's immediate cash flow requirements, divesting non-essential assets within the subsidiary to generate quick liquidity, even if it compromises the subsidiary's long-term operational capabilities and market competitiveness. The correct answer is B. Conduct a comprehensive feasibility study that includes detailed market analysis, competitor benchmarking, and robust financial projections for the next 10 years, factoring in both the upfront investment costs and the anticipated long-term revenue growth and market share gains, while also exploring potential financing options that minimize immediate impact on the parent company's cash flow. Explanation: this scenario presents a professional challenge because it requires balancing the immediate financial pressures of a subsidiary with the long-term strategic objectives and the ethical obligations to all stakeholders, including minority shareholders and the broader business community. Jardine Cycle and Carriage, operating within its specific regulatory environment, presumably Southeast Asian markets with varying but generally robust corporate governance expectations, must navigate potential conflicts of interest and ensure transparency. The decision-making process is complicated by the need to maintain investor confidence while pursuing growth opportunities that might not yield immediate returns. The correct approach, which involves a comprehensive review of market conditions, competitor analysis, and a detailed financial projection that accounts for both short-term costs and long-term benefits, represents best professional practice. This aligns with principles of sound corporate governance and fiduciary duty. Specifically, it adheres to regulatory frameworks that mandate responsible financial management, fair treatment of all shareholders, and strategic decision-making that prioritizes sustainable value creation. Ethical considerations are met by ensuring that decisions are not driven solely by the immediate needs of the parent company, but by a holistic assessment of the subsidiary's long-term viability and profitability, thereby protecting the interests of all stakeholders. An incorrect approach that prioritizes immediate cost-cutting without a thorough strategic review risks alienating employees, damaging brand reputation, and potentially undermining future growth prospects. This could lead to regulatory scrutiny for failing to act in the best interests of the company and its shareholders, potentially violating corporate governance codes that emphasize sustainable business practices. Another incorrect approach, focusing solely on the parent company's immediate cash flow needs without considering the subsidiary's operational capacity or market realities, could be seen as a breach of fiduciary duty. This might expose the company to accusations of asset stripping or unfair intercompany transactions, which are often subject to strict regulatory oversight and could result in penalties. A third incorrect approach, deferring the decision indefinitely due to internal disagreements, demonstrates a lack of decisive leadership and strategic direction, which can erode investor confidence and lead to missed market opportunities, potentially violating regulations that require timely and informed corporate decision-making. Professionals should employ a decision-making framework that begins with clearly defining the strategic objectives and constraints. This should be followed by a thorough data gathering and analysis phase, involving all relevant internal and external stakeholders. Crucially, the evaluation of options must consider not only financial implications, but also ethical, reputational, and regulatory impacts. Finally, the chosen strategy should be clearly communicated and implemented with robust monitoring and review mechanisms. Question 20. Strategic planning requires a nuanced approach when assessing the performance of a subsidiary operating in a different market. Jardine and Carriage is considering how to address a subsidiary that has consistently underperformed financially over the past 2 fiscal years. The local management attributes the underperformance to a combination of increased local competition and unexpected supply chain disruption. The parent company's head office is concerned about the ongoing financial drain and is exploring various options. Which of the following represents the most prudent and professionally responsible course of action for Jardine and Carriage strategic planning team? Option A. Initiate a comprehensive review of the subsidiary's operations, engaging directly with local management to understand the specific challenges and collaboratively develop a detailed, data-backed turnaround strategy that addresses both market competition and supply chain issues, with clear performance metrics and timelines. Option B. Immediately implement significant cost-cutting measures across the subsidiary, including workforce reductions and renegotiation of supplier contracts, to stem financial losses as quickly as possible, regardless of the impact on local operations or employee morale. Option C. Begin exploring options for the immediate sale or divestment of the underperforming subsidiary to a third party, prioritizing a swift exit to minimize further financial exposure for the group. Option D. Mandate a new management team from the parent company to take over the subsidiary and implement a standardized business model that has been successful in other markets, without extensive consultation with the existing local team. The correct answer is A. Initiate a comprehensive review of the subsidiary's operations, engaging directly with local management to understand the specific challenges and collaboratively develop a detailed, data-backed turnaround strategy that addresses both market competition and supply chain issues, with clear performance metrics and timelines. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial pressures of a subsidiary with the long-term strategic interests of the parent company, Jardine and Carriage. The decision-maker must navigate potential conflicts of interest and ensure that actions align with both group-wide policies and the specific regulatory environment of the operating jurisdiction. Careful judgment is required to avoid short-sighted decisions that could jeopardize future growth or violate compliance standards. The correct approach represents best professional practice because it prioritizes a thorough, data-driven assessment of the subsidiary's financial health and market position. This involves engaging with local management to understand the root causes of underperformance and collaboratively developing a sustainable turnaround plan. This aligns with principles of good corporate governance, which mandate responsible oversight and support for subsidiaries, while also respecting the autonomy and local expertise of the subsidiary's management. It also adheres to regulatory expectations for transparency and accountability in financial reporting and strategic decision-making. An incorrect approach that focuses solely on immediate cost-cutting without understanding the underlying issues would be professionally unacceptable. This could lead to the dismissal of valuable local talent, damage to supplier relationships, and a failure to address the core problems, ultimately harming the subsidiary's long-term viability. Such an approach could also violate ethical obligations to employees and stakeholders, and potentially contravene regulations related to fair labor practices or responsible business conduct. Another incorrect approach, which involves imposing a top-down solution without consulting local management, ignores critical local market knowledge and operational realities. This can lead to ineffective strategies, resistance from the subsidiary's team, and a breakdown in communication. Ethically, it demonstrates a lack of respect for the subsidiary's personnel and their contributions. From a regulatory perspective, it could lead to non-compliance if the imposed strategy is not feasible within the local legal framework, or if it creates undue financial strain that impacts regulatory adherence. A third incorrect approach, which involves divesting the subsidiary prematurely without exploring all viable recovery options, might be driven by a desire to exit a perceived problem quickly. However, This could result in a significant loss for the parent company and a failure to fulfill its fiduciary duties to shareholders. It also overlooks the potential for a successful turnaround, which could create long-term value. Ethically, it could be seen as abandoning a business unit and its employees without due diligence. A professional decision-making process for similar situations should involve a structured approach. First, gather comprehensive data on the subsidiary's performance and market context. Second, engage in open and honest dialogue with local management to understand challenges and opportunities. Third, develop a range of strategic options, assessing the risks and benefits of each, including potential turnaround plans and, as a last resort, divestment. Fourth, consult with relevant internal stakeholders and legal/compliance advisors to ensure alignment with group strategy and regulatory requirements. Finally, implement the chosen strategy with clear objectives, timelines, and accountability measures, while maintaining ongoing monitoring and evaluation.